US recession is finally here. The numbers are coming out in the job market and showing a very clear decline in the number of jobs in America. Payrolls are going down, job openings are going down, and hiring is now plummeting to the lowest level since 2008. The question is, what is this labor market recession going to do to the rest of the economy, housing market, and stock market over the next year? And where is this recession hitting hardest? I'm going to answer those questions for you in this video because this is data that you guys need to know as potential home buyers or investors in 2025 going into 2026. And so the big thing we got to pay attention to, everyone, is the big drop in the job market. Indeed just came out with a report today showing that job postings have plummeted over the last 2 years in America, and now we're at pre-pandemic job postings levels according to data from Indeed. So the job postings are down about 30% according to Indeed, while ADP, the payroll processor, says the US lost 32,000 jobs in September. So we're now officially going into negative month over month job growth. According to ADP, the US shed 32,000 private sector jobs in September. ADP doesn't report government workers, actually. So this is all private payrolls, private workers. This was a surprise job loss in September and the latest sign that the job market and labor market is weakening, according to the Wall Street Journal. On top of that, everyone, data from the BLS shows that the hiring rate in America has now plummeted as of August 2025 to the lowest level of hiring since 2008 2009. So we now have a 2008-2009 level of hiring in the US economy, on par basically with a recession. We are in a labor market recession. This data is making that clear. The question is, how much worse is this going to get? And what are the cities that are going to get hit hardest? And what is this going to mean for you guys out there? If you're someone trying to find a job, if you're someone trying to buy a house or investment property, how do you interpret this labor market slowdown? Because it can be confusing, everyone. You know, you see the labor market in a free fall right now. No one's hiring. The job growth is going negative. Yet at the same time, the stock market keeps going up and GDP growth keeps going up. The US just had a strong second quarter GDP number. The third quarter GDP number is also looking pretty strong in the 3 to 3.5% range. So how do we square these kind of opposing forces, and what does it mean for the economy going forward? Well, everyone, one of the things I like to look at is, the long-term norms. If we go back 70 years and look at the US economy, what does it tell us about where the economy is heading into the future? And the one thing you all have to understand about today's economy is that while the job market is plummeted and the hiring is plummeted, and it's really difficult to find a new job right now, especially in tech, especially in finance, the unemployment rate in the US is actually still pretty low. So the unemployment rate bottomed out at 3.4% in April 2023. Now it's up to 4.3%. So the unemployment rate is going up, but you can see this is still a historically low level. In fact, it's one of the lowest levels of unemployment in the last 55 years. So this is yet another juxtaposition, a confusing aspect of the economy. We have extremely low hiring. We have the lowest hiring rate going back to 2008, 2009, yet the unemployment rate is still pretty low. And there's a reason for that, everyone. The reason is because while companies have stopped hiring people, they haven't yet started firing people. So you could see the layoffs and discharges rate is only 1.1%. And that's a pretty low level. This graph is kind of skewed due to the pandemic, but a 1.1% layoffs and discharges rate, that's about half the level we saw in 2009 when it went to 2%. So what this means, in 2009, companies were laying off 2% of all their workers in a given month. Now they're only laying off 1.1% of all their workers in a given month. And so we're in this economy that's slow to hire, so slow to hire that it's a recessionary hiring market, but they're also still somewhat slow to fire. We see some announcements of big layoffs. ExxonMobil is doing some layoffs. Microsoft just did some big layoffs a month or two ago. But we have not yet seen like the major firing, the major layoff brigade hit. And I think that's kind of confusing some people. right? I think that's kind of tricking some people into thinking that the job market is healthy or that the economy is healthy. The fact that the layoffs haven't yet surged. But make no mistake, the economy is not healthy. The job market is not healthy. The hiring rates are literally at some of the lowest levels that we've ever seen. So if someone's unfortunate enough to find themselves out of a job, it's really hard right now to find a new job. And that tends to happen before the layoffs go up. I'm going to talk a little bit more about that. When are the layoffs really going to start to increase in the future? But one aspect of this job market that I actually kind of want to talk to you guys about, in case you're someone who might be looking for a job, or maybe you're fearful that you might lose your job, or maybe you just want to understand what sectors of the economy are doing best. I want to break out some data on the job availability by sector and field, because this is very interesting. What are the sectors where there's a lot of job openings? What are the sectors that are in a massive recession right now? There's a lot of differences across the US economy. It's not a one size fits all situation by any means. And if you find yourself to be in certain professions, everyone, you're actually still going to find good demand. For instance, therapists. Demand for therapists is way up compared to pre-pandemic. According to Indeed, job postings for therapists are up 85% from pre-pandemic norms. Job postings for physicians and surgeons are up 84%. Job postings for civil engineering are up 56%. Job posting for veterinary is up 48%. Personal and home health care is up 46%. Sports, interestingly, sports job postings are up 47%. Dental job postings are up 38%. Pharmacy job postings are up 28%. Medical technician postings are up 28%. Logistical support up 28%. What do you guys notice actually about the top 10 fields where the job postings are still really high? Can you guys spot the similarity in the trend? It's a lot of healthcare jobs. It's a lot of healthcare, therapy, physicians, vet, personal home and healthcare, dental, pharmacy. It's a lot of healthcare. That's where the job growth is in the economy right now. And if you actually isolate healthcare jobs, they're up 38% on job postings since before the pandemic. So if you work in healthcare, you're not seeing a recession right now in your job market. In fact, you're seeing buoyant demand in your job market. However, if you work in other fields and industries, for instance, if you work in software development, there is a major recession right now. Job postings in software development are down 37% from pre-pandemic norms, according to data from Indeed. Media and communications job postings down 36%, according to data from Indeed. Scientific research and development down 31%, marketing down 23%, arts and entertainment down 23%, human resources down 15%. Architecture down 14%, hospitality and tourism down 12%, retail down 11%. So this is the bifurcated nature here of the US job market. On average, there's about 4% more job postings than 5 years ago, which isn't very good since the population has grown so much. But we have these sectors here in orange that are really going down. And what I think is interesting about that is a couple things, right? I started actually thinking about real estate when I look at that. And I think, well, if there's lots of job postings in healthcare, then what areas of the country are going to do better? What neighborhoods are going to do better? Well, it's going to be ones near hospitals, right? If there's a city that has a big healthcare presence, I'm thinking Cleveland, I'm thinking Pittsburgh, I'm thinking Boston. Those cities structurally are going to do better through this labor market recession because the industries that power those cities in terms of their job market and their real estate market are doing better. Conversely, think about areas that are really exposed to tech and media, right? Areas really exposed to tech and media in their local economy are going to struggle in this labor market recession. California is the first place, I think. California in LA, a lot of that economy is based on media, and the job postings are down 35%. In fact, the Wall Street Journal just had an article today about how the job market in Los Angeles is really bad right now. Let me just pull this up, guys. This is really, really interesting. According to the Wall Street Journal, LA's entertainment economy is looking like a disaster movie. And I read this article this morning. It's actually kind of sad, everyone. A lot of the traditional creatives in Los Angeles, they are really having difficulty finding work, working in movies and TV shows. A lot of that's been offshored to other countries. And there's some crazy, crazy stats here talking about different people in LA who are struggling to find work. Occupancy rates of sound stages for studio productions in greater Los Angeles, has plummeted from 90% to 62%. Wow. Uh, the number of writers who are reporting earnings has gone down probably by about 15% over the last 2 years. And so this is just one example, right? I showed you guys the data on the decline in job postings in media. Well, the Wall Street Journal today just wrote an article about it in Los Angeles. So think what that means for Los Angeles's housing market, Los Angeles's rental market. We're seeing a labor market recession unfold right now in Los Angeles. It's not good what's going on there right now in the job market, and that's likely something that's going to spill over into the real estate market. Because if people can't find jobs, if people are forced to leave, are they going to buy a $1.2 million house in LA? Are they going to be able to afford the $3,700, $3,800 rent in Los Angeles? Probably not. So I would start paying attention. If you're a home buyer or investor who wants to buy a house in the next 6 to 12 months, I would really actually also start paying attention to the labor market signals that are coming out of your area, because they could have a big impact on what's going to happen with home prices. Like, you don't necessarily want to buy a house right now in an area where the job market's in recession, because it could mean it's going to go down by more. Now, conversely, this could also lead to opportunity, right? If you've been someone who's been waiting on the sidelines and you're in an industry that's not exposed to the labor market recession, and you feel confident that you're going to keep your job and you got a lot of cash stacked up, you could potentially use this as an opportunity over the next year to buy some distressed properties, buy some distressed properties at discounts. And I think, ultimately, we're going to have to see more of that in the future to bring more homes to the market, home prices down. And I'm actually live right now. I have a members only chat live. So if you're a channel member, feel free to leave a request. But I'm going to talk more in the meantime about what's going on in the job market. Because one kind of strange thing, everyone, is that while we're seeing this negative labor market statistics really come out, one area we're not seeing it today is from the US government. So the US government hasn't reported their jobs numbers today. The government shutdown is delaying a key monthly job report at a pivotal moment for the US economy. So today, actually, they call it Jobs Friday, is typically what they call it. They call it Jobs Friday, and we didn't have a Jobs Friday today because the US government didn't report the jobs figures, because the people who work for the Bureau of Labor Statistics are furloughed right now. So we don't actually have government jobs data for September. So the data I was showing you earlier in this video, it's all from private sources. The ADP payroll report, that's a private company, ADP. They process payroll for different companies. They're showing that loss in jobs for September. We don't yet know the US government estimate for the loss in jobs in September. We'll see if that estimate comes in the next week. Hopefully the government starts up again, but we have private payroll processor ADP showing a $32,000 job loss in September. And then we have Indeed, who's the job postings website. They're showing that job postings have gone way down. Job postings have plummeted, right? And so we don't, the US government is actually missing in action here. And we don't have the government data. I actually polled some of you guys and I asked you the question, do you trust the US government job report figures? Only 8% of you said you do trust them. 79% of you said you don't trust them, they're too high. 13% of you said you don't trust them, they're too low. So maybe it's actually not that big a deal that we don't have the jobs figures from the government today, because only 8% of you trust them to begin with. I think there is a lack of trust going on with US government jobs data. But altogether, folks, like, this labor market is really slowing. And what's interesting about it is the fact that the labor market's slowing. It's really hard to find a job, but stock market keeps going up. How do you, rationalize that in your head? How could the labor market be going negative? How could we now be losing jobs, according to ADP, but the stock market keeps going up? It doesn't make intuitive sense, because if we're losing jobs, that's fewer people earning an income. And if there's fewer people earning an income, the logical conclusion is going to be reduced consumer spending. And if there's reduced consumer spending, that should mean lower revenue for businesses, which should mean lower earnings, which should mean lower stock prices. But so far, there seems to be somewhat of a disconnect. And I think that disconnect has to do with AI, right? What AI's impact is so far on the job market and the profitability of big Wall Street companies. And I think many of these big Wall Street companies are using AI to increase their productivity, efficiency, and profitability at the expense of hiring more workers. And so we're actually seeing a reduction in hiring, but then the profits for these big Wall Street companies, they're going up. The earnings growth in the second quarter of 2025 was really strong. Earnings growth was around 10 to 12% year over year for the big Wall Street companies. And so the earnings for the Wall Street companies is still going up, and the consumer spending is still holding on. So the consumer spending is still holding on. This is the other piece to this equation that's a bit confusing. How is the US consumer, in the face of inflation and in the face of declining job market, still spending, right? And this is kind of a really confusing thing. And I think this ultimately explains why we haven't seen like the shoe drop, so to speak, on the economy. Like why we haven't seen the shoe drop on the stock market. You know, you can see retail sales. We had 5% year over year retail sales growth in August. Retail sales rise again in August, bucking the economic slowdown. Retail sales grew in July. Retail sales rose 0.6% in August. So people still seem to be spending money, but yet their job prospects are dim. Inflation is eating up their income. And more people on the lower half of the income spectrum, especially, seem to be, you know, struggling to say the least. And, you know, I think ultimately that's being supported by the top, let's just say 10, 20% of earners. The top 10% of earners, everyone, are doing 50% of the consumer spending. This is a crazy article that came out from the Wall Street Journal earlier this year. The US economy depends more than ever on rich people, according to the Wall Street Journal. Again, if you've been wondering, like, why in the face of a bad job market, the stock market is still going up, why the economic situation still seems okay on the surface, it's because consumer spending among the top 10% of Americans has surged. So the top 10% of Americans are keeping things afloat. According to data from Moody's, the top 10% of earners, let me just zoom in on this so you guys can see it. Households making $250,000 a year or more are splurging on everything from vacations to designer handbags, buoyed by big gains in stocks, real estate, and other assets. Those consumers now account for 50% of consumer spending, a record in the data going back to 1989, according to Moody's Analytics. 3 decades ago, the top 10% of earners only accounted for 36% of spending. So this is a really key piece in understanding the current economy. Top 10% is 50% of the consumer spending. They used to be 36% of the consumer spending. So they're taking up more and more of kind of the share of spending. And ultimately, you know, we're relying more on rich people to sustain this economy. We're relying more on wealthy people to keep the economic train moving. And I just wonder how long that can last for. Because if you have the top 10% of earners accounting for half the spending, and that's propping up retail sales, and that's propping up earnings, and that's propping up stock prices, which is giving the perception that everything is good. What happens if something eventually happens to the top 10% of earners, right? I mean, what happens eventually if like enough people in finance and tech lose their jobs that the top 10% of earners cut back? What happens if the stock market eventually does have a correction? It leaves your economy very exposed to a small subset of the economy. Think about that. Folks, I really want you to understand this. 10% of people are driving the whole economy right now. 10%, the top 10% of the economic spectrum, of the top 10% of income, they are driving the spending. And they are then driving the earnings, and they're driving the stock prices. So what's your economy really built on? Like, is your economy built on something stable with a strong foundation, if that's the case? You know, I would say the answer is no, right? Your economy is really pigeonholed into, you know, often baby boomer households that have a lot of wealth, just keeping it going. And then you have Gen Z and millennial households who are struggling a lot more, who are really feeling the recession. And yeah, if you're in certain industries, you're also really feeling the recession because, you know, the job prospects are low. And so the reason I'm taking my time here to lay this out for you guys is so you can have a full picture of actually what's happening and not be confused by what's happening. Not be confused when you hear job market plummeting, ADP payroll going negative, job openings going down, but then you see stock prices surging. The reason for that is the reliance on the top 10% doing 50% of the spending, which is juicing retail sales, which is juicing earnings, which is juicing stock valuations. That is what's happening. And I fear that at some point it's an unstable house of cards that's going to break. I couldn't tell you when it's going to break, but More and more we see these warning signs occurring in the economy. And just going back to real estate, what's this going to mean for real estate? What's this going to mean for home buyer demand, especially? We've talked a lot on this channel about how home buyer demand is near the lowest level in 30 years. The home sale activity is really low. People can't afford houses right now. But not only can they not afford houses, there's an increasing perception that they might lose their job, or that if they did lose their job, they're not going to be able to find another one. And you want to talk about something that's going to stop someone in their tracks from buying a home. Well, it's the thought that I might lose my job. It's the thought that, oh, maybe I saw my coworker get laid off 2 weeks ago or 6 months ago, and they're still having a hard time finding a job. When people see that, and they see more and more of that in the economy, they're going to put the brakes on home buying, right? So you have the affordability constraint on home buying that was already suppressing demand. Now you have the what I would call economic unease constraint on home buying from people who just don't feel confident enough to take out a $400,000 or $500,000 mortgage to buy a house. And I don't blame them at all. How could you blame someone for not wanting to take out a mortgage, paying 35% of their gross income to their mortgage payment, and then they feel like maybe they're in an industry where their job is getting eaten up by AI? I mean, I'm not going to blame anyone for putting the brakes on home buying as far as that goes. And so maybe we'll see a slight increase in home buyer demand in the next year as interest rates drop, but we're not going to see a massive surge. At the same time, I think if more people feel economic unease and they might lose their job, we're going to see more people sell their home. We're going to see more people get into a situation where they have to sell their house, or maybe have to sell their second or third house to sustain their lifestyle, to maybe cash out and fund their lifestyle and fund their expenses. And I was actually looking at some data a couple days ago that I want to share with you all about the housing market, about, are we going to see inventory continue to increase? Are we going to see, the home prices continue to drop? Prices are dropping in half the states in the US right now. Are we going to see that spread? And this graph that I'm about to show you, everyone, it's really, really interesting because it's comparing the amount of people that have a 6% mortgage rate right now to the amount of people that have a sub 3% mortgage rate. And a very common argument that we see put forth by people who are bullish on the housing market is they say something like this. They say, we won't see a home price crash because there's so many people with sub 3% mortgage rates. You guys can let me know if you've seen anyone say that, if you've seen it in the comment section. I know I've seen it in the comment section to my videos before. The narratives that people can spin for, justifying a bullish housing market, they've really gone away. There's not that many narratives left that you can clasp onto to say that home prices are still going to go up. But this thing about sub 3% mortgage rates, people are locked into their homes at sub 3% mortgage rates. It's one of the last standing arguments from people who are bullish on the housing market. And I just want to show you all this graph, because this graph is really, really interesting. It punctures a hole in that argument. We're looking at the orange line, the percentage of existing mortgage holders with a 6% plus mortgage rate. Okay? And then the blue line, the percentage of mortgage holders with a sub 3% mortgage rate. And by the way, Edric Kirkman, I see you here in the chat. Appreciate you becoming a channel member. Let me know if you have any questions here. Sub 3% mortgages. We peaked at a quarter of all mortgages being sub 3% in 2022. This is when all the people refinanced at the 3% rates, right? We went from 3% people on a sub 3% rate to 25% mortgages on a sub 3% rate. That's now gone down incrementally every quarter, down to 20%. Now, in the same span, the number of people with a 6% plus mortgage rate has rocketed up from 7% to 20%. So we have roughly the same amount of people right now who have a mortgage that are sub 3 and above 6. Probably by the end of 2025, by the end of this quarter, we will have more people with a 6% plus mortgage rate than a sub 3% mortgage rate. And that's something that's really interesting. It's something that suggests we're going to just continue to see more inventory hit the housing market over the next several years. With each month and quarter that passes, you're just going to have more people churning their mortgage, either refinancing or buying a new home at market mortgage rates, right? So let's just say in another year, it's probably going to be like 25% of people have a 6% plus rate. Only maybe 18% of people have a sub 3% rate. So each passing month, each passing quarter, there's going to be fewer people with cheap mortgages in the US, more people with expensive mortgages, which is going to mean more people induced to sell because their payment is too high. And so that's just going to be the upward pressure, the upward lift on inventory that just keeps coming the next couple of years. We're just going to see inventory keep growing, new listings keep growing is my prediction, as more and more of those sub 3% mortgages just get eliminated from the market. Because again, some people do have to sell, death, divorce, marriage, downsize, upsize, move for a job. Some people do have to sell, right? And so we're just seeing fewer and fewer of those cheaper mortgages. But the way I actually like to think about it, everyone, and if you're a home buyer trying to understand where the market's heading in your area, think of it like this. On one side, we're going to have the pressure to sell, right? With more and more mortgage holders having a high mortgage rate. So that's going to push inventory up. Now, that's going to be counterbalanced on the other end by the number of first-time home buyers who feel pressured to buy. Theoretically, if rents go up, if rents were to go up, you'll see more first-time buyers enter the market, because if rents go up, more people are going to say, let me just buy. Now, the thing is, everyone, the situation we have now is an interesting one. It's one where the number of people who, and let's just actually see if I can find this graph, everyone. I'm kind of winging it right here. I want to see if I can find this graph for you all, because it shows the comparison of, oh, this is the graph I want to show you. Okay, this graph explains everything about the housing market. The orange line is the average payment for people with an existing mortgage, $1,900 a month. The blue line is the monthly rent for renters, $2,000 a month. The green line is the mortgage payment to buy a house with existing mortgage rates. So it costs you $2,750 to buy a house per month now on existing mortgage rates and prices. Okay? It costs you $2,000 a month to rent an apartment, $1,900 a month to stay in your existing house with your existing mortgage. The whole reason that there's no demand right now, in addition to economic uncertainty, is the fact that the payment to buy is way above the payment to rent and to stay in your house, right? So the payment to buy is about 40% above the payment to rent and payment to buy. So why would you buy? Because you're going to be taking on a higher monthly payment. Now, here's what you got to pay attention to. What's the trend in mortgage payment for current owners versus the trend in monthly rent? If the mortgage payment for current owners goes up faster than the monthly rent, you are going to see pressure to sell. You are going to see more pressure to sell versus buy, because more of the existing mortgage holders are feeling like their payments are going up. And I know I'm getting into some detail here, everyone, but stick with me on this. It's just very important that you understand like how this housing market is actually working. The issue I see is that the monthly rent isn't really growing enough. And actually, the monthly rent is going down in many markets. And I did a report on this actually a couple days ago, everyone. The monthly rent is at its lowest growth rate in a long time. So single family rent growth, according to John Burns Consulting, is at its lowest rate in 13, 14 years. Single family rent growth is at its lowest rate in 13 to 14 years. So that means the blue line, monthly rent, is just going to kind of stay stable, maybe go up a bit. But then you have the orange line, the mortgage payment of current owners, going up by a lot each quarter because you're swapping out mortgage holders below 3% for mortgage holders above 6%. And this is ultimately why I believe, in addition to the lack of affordability, we're just going to see inventory continue to grow on the housing market because there just isn't the impetus for first-time buyers to buy. It's way cheaper to rent. The rent isn't going up. But we're going to see more of an impetus for current owners to sell. Back in 2020, the current owner mortgage payment was $1,400 a month. Now it's $2,000 a month. That's going to keep going up in the future. And then you pair that with some of these current mortgage holders potentially losing their job. I just think we're going to see more and more new listings hit the market. We'll see some buyers come back in, but not enough to stem the tide of inventory, which is why home value declines will likely spread over the next year. Appreciate you guys sticking with me on that. I know I just did like a 400 level deep dive on the dynamics of mortgage rates in the current market. Let's take some requests, everyone. Let's take some requests. I am live. I'm live. This is a members only chat today. Sometimes I do members only chats. We have Edric has a question. He's saying, glad to be a new channel member. Wondering if you could take a look at Powder Springs, Georgia, if you have the time. Powder Springs, Georgia, 30127. Powder Springs, Georgia, 30127. Well, let's take a look, everyone. What is going on? We actually just updated the data on Reventure app for September, everyone. So we just updated the September data on Reventure app for Realtor.com. Let's see here. Looks like we're having a little issue here on the map. So let's go to Atlanta. Let's go to Atlanta. We can see home values in Atlanta, the Atlanta metro, are down 3% over the last year. So home values in Atlanta are down 3% over the last 12 months. If we look county by county, we can see here in Cobb County, they're down 2.7%. In Fulton County, they're down 3.7%. In DeKalb County, they're down 5%. In Clayton County, they're down 7.8%. So we're seeing values drop all across the Atlanta metro right now. And the whole reason we're seeing that is because inventory is going up. Sales inventory growth is up anywhere from 14 to 27, 39% year over year. Up in Forsyth County, inventory growth is up 52%. Here at Reventure, our 12-month forecast for these areas is down over the next 12 months. We have a negative 12-month forecast all across the Atlanta metro, minus 2% in Cobb, minus 4% in Fulton, minus 7% in DeKalb, minus 6% in Clayton. And so we are already seeing prices drop in Atlanta. That's already happening. We're seeing these drops biggest on the central and south side of the city. The strongest area right now is probably Cobb County and Forsyth County, where our forecasts are only minus 2%. But remember, folks, our forecasts don't really take into account any assumption for an increase in unemployment. We have a pretty baseline forecast based on just what's going on the market today, how the technical indicators are moving. So, we could see these forecasts go more into negative territory if we see these job losses mount, if we see the hiring slowdown continue. I wouldn't be surprised if some of these forecasts get revised down. You could see ultimately, where do we have the biggest downward forecasts here over the next 12 months on home prices on Reventure app? Well, it's Colorado, actually, number one, everyone. Colorado, minus 6.4%. Arizona, minus 5.3%. Texas, minus 5.5%. Florida, minus 6.2%. These forecasts, a 5-6% drop in a year, to some, that might not sound like a lot, but for the housing market, that is a big drop in 1 year, a 5 or 6% drop in just 1 year, because the typical housing downturn takes 4 or 5 years to play out. So if you have a 5% drop per year for 4 or 5 years, that ends up being pretty big figures. It takes a while for sellers to kind of get out of their own way a little bit. One interesting thing, everyone, I was actually taking a look at this job growth data by state, and I was looking at the states where the job growth is best and worst right now. Now, this was using data from the Bureau of Labor Statistics. If you look on this map of all 50 states, the areas in orange have the worst job growth over the last 6 months. So Nevada is now losing jobs over the last 6 months. Kansas is now losing jobs over the last 6 months. New Jersey is losing jobs. DC is losing jobs. Maryland's flat. Rhode Island's losing jobs. New Hampshire's losing jobs. Maine is losing jobs. So we have job losses now showing up in specific states already. South Carolina, interestingly, is doing much better. Job growth in South Carolina over the last 6 months is 1.6%. There is no recession yet in South Carolina. That market keeps expanding. And I actually took a look at this data also by metro area. So I wanted to say, what are the metro areas in America that have the best job growth over the last 6 months? You can see Charleston, South Carolina is number one. So Charleston, South Carolina is continuing its job growth from February to August 2025, plus 3.2%. Salem, Oregon, plus 2.9%. Spartanburg, South Carolina. Fayetteville, Arkansas. Charlotte, North Carolina. San Antonio, Texas. Boise, Idaho. Winston-Salem, North Carolina. Syracuse, New York. Stockton, California. These are the highest job growth markets. There is no recession yet. There is no labor market recession in these areas. They're still actually adding jobs. Even New York City is still adding jobs, surprisingly. However, if we go to the bottom of this list, we can see the metros that are already contracting on jobs. The metros that are already contracting on jobs. Davenport, Iowa. Naples, Florida. St. Louis, Missouri. Des Moines, Iowa. Milwaukee, Wisconsin. Madison, Wisconsin. Portland, Maine. Wichita, Kansas, Portland, Oregon, Las Vegas, Spokane, Washington, Sioux Falls, South Dakota. San Francisco is losing jobs. Asheville, North Carolina is losing jobs. Providence, Rhode Island is losing jobs. Kansas City, Missouri is losing jobs. So we have official job declines in these metro areas here already in orange. It's an interesting list because we're not seeing home prices drop in all those markets. The way I would think about the labor market for you guys, if you're looking at buying a house, is there's a loose relationship between the labor market and home prices. In an area like New Jersey is now losing jobs, but its housing market's still on fire because there's so little inventory that even if the job growth is minus 1%, that's not enough to counteract the fact that there's so little inventory. Conversely, South Carolina is gaining a lot of jobs still right now. But there's so much inventory on the market in South Carolina that it doesn't matter that a 2 or 3% increase in jobs, that's not enough to counteract how much inventory there is on the market. Eventually, though, I think we will see the labor market and the job market filter through to the housing market in all these different areas over the next several years. You can only put off, if you're losing jobs consistently in an economy, you can only put that off for so long before it spills over in terms of inventory and home prices. Conversely, if an area keeps adding jobs, keeps adding jobs, keeps adding jobs, it's going to put upward pressure on home prices. But one reason why I love this inventory data in particular for home buyers and investors is that it's giving you a real-time indication of what's happening in the market. When you look at the inventory, you look at the days on market, you look at the price cuts for your area, that's giving you a real-time indication of what's going on. It factors in all these things already. How many homes are sitting on the market for sale? That factors in the job market, right? That factors in how many people are moving there. That factors in how many people are forced to sell, how many people maybe are struggling to pay their mortgage. And the thing we're just really seeing, folks, is the inventory levels are starting to get really high in some different states. The inventory in these states in red is now above the long-term average. We have a new number one state actually that has the most inventory, and that would be Tennessee. Inventory in Tennessee is 53% above the long-term average. Inventory in Colorado is 51% above the long-term average. In Texas, it's 49%. In Florida, it's 49%. Interestingly, Florida is no longer the number one state for inventory. Tennessee is now the number one state for inventory. We're just seeing all types of homes hit the market for sale in Tennessee, a record number of homes for sale in the last decade. So let's see, where does Tennessee rank on jobs? Well, Tennessee still added 0.7% job growth the last 12 months, which is positive. It's doing a little better than the U.S. average. But despite that job growth in Tennessee, the homes for sale keep piling up, right? The homes for sale keep piling up in Tennessee. The days on market keeps going up. We now have the highest days on market in Tennessee. And so I would say in the end, if you're a home buyer and investor, pay attention to the labor market. It's important. But until we see like an unemployment rate surge, until we see massive layoffs, pay more attention here to the micro housing market data because it's already telling you, what's going on in your market. Tennessee has 63 days on market. Arizona has 71 days on market. But look actually how low the DOM is still here in the Midwest and Northeast. We have really low DOM in the Midwest and Northeast, Michigan, Ohio, Illinois. Folks, homes in Illinois are only on the market for 38 days. So the lowest days on market in America is Illinois. Geez. What's Illinois' job situation look like? Illinois actually is down on jobs slightly in the last 6 months. So Illinois is starting to lose jobs. The labor market recession is starting to hit Illinois. Not feeling it in the housing market, though. Days on market is only 38 days in Illinois. Homes are still quite literally flying off the shelves. I mean, before the pandemic, the DOM in Illinois was 53 days in August 2019. Now it's 38 days in August 2025. Still have just like a really tight housing market in Illinois. Nebraska still looks pretty tight. New Jersey, very tight. I talked about New Jersey before. Days on market, New Jersey is only 40 days, has not improved at all the last 5 years. Before the pandemic, it was 63 days. So we still have a positive 5.7% 12-month forecast in Illinois. Positive 5.7%. This is a situation here in Illinois where there's still bidding wars. You go to Suburban Chicago, there's still bidding wars in suburban Chicago. So important that you guys understand that. We do have a bifurcated housing market. We have one where, really, we still have a tight market. We still have bidding wars in these states in blue and these states in red. Home values are dropping. Days on market in Florida, everyone. 87 days. 87 days on market now in Florida. August 2025. Typical DOM almost 3 months in Florida. This downturn in Florida continues. Home values in Florida are down 5.1% over the last year. When will it be a good time to buy in Florida? When for you as a buyer and investor should you get into Florida's housing market? Should you hold off getting into the Florida housing market because of the oncoming labor market recession, one that might have already started? In the end, you got to weigh those risks. I think the risks are tilted to the downside, right? We're looking at all this data on RevenTrap. This is base case. This is like 4%, 4.2% unemployment driving, this data here. However, we look at the hiring chart from Indeed, the job postings continue to go down. ADP is saying we lost 32,000 jobs. In addition, ADP is also showing, if I can find it, folks, ADP is also showing that the wage growth is slowing. ADP also does wage growth. They handle the employment processing for something like 25 million employees. The wage growth is also slowing. Yeah, the Indeed Hiring Lab is also showing that the wage growth is slowing. Let's look at the Indeed wage tracker, see how wages are doing, because wages are also really important to consider. Wage growth peaked at 9.4% in 2022, according to Indeed, and is now 2.6% year over year. So the jobs posted on Indeed, the job postings website, the wages are up 2.6% year over year. That's less than it was prior to the pandemic. So the wage growth, there's still some wage growth. It's not zero. It's still 2.5, 3%, maybe 3.5% in certain surveys. But it's not enough wage growth to really bring buyers back into the housing market. The wages aren't growing enough to instill confidence in home buyers to improve their affordability. And so that's something that's just really important to kind of understand. All right, everyone. What else we got? We got some more comments here. Channel members rolling in with the comments. Ed saying, Nick, I've been with you since year one. Wanted your opinion on the huge disconnect from used to new homes in Cape Coral. New market is 50%, or I should say $50,000 less. $50,000 less, and they offer 3.99% FHA. So Ed is looking at, I presume you're looking at these houses, Ed. Cape Coral, Fort Myers, new market. You're buying a new home from a builder, $50,000 less than the resale, and they offer 3.99% mortgage. Ed, is that on a 30-year term, or is that just a 1 or 2 year buy down? Would be curious to know. Ed, my assumption here is that the resale market's eventually going to follow the new home market. The new home market is kind of real time, right? Builders build homes to sell homes. They're going to price them to what they need to sell them at. And, if a builder is giving a 3.99% mortgage rate, that Ed's confirming that. 30 years. So the builder in Cape Coral is giving a 30-year mortgage at a 3.99% rate. Sorry, folks. Like, if you're an existing owner in Cape Coral trying to sell, then, like, what's going to happen here? So Cape Coral, by the way, is down 10% in the last year. 10% in the last year. Cape Coral is down. So this is a market that's already in steep correction across the entire market. But the builders clearly have cut the price by more. The builders have cut the price by more. And, we have 3 years in a row, values in Cape Coral have gone down. They're down about 16, 17% from peak. ReVenture, we think they're going to go down another 9%. So, Ed, I think it depends. A 3.99% mortgage rate on a 30-year term is a pretty good deal. You're not going to see a market mortgage rate of 3.99 anytime soon. You might want to jump on that, 3.99%. Values have already gone down. They're giving a $50,000 discount. I'm actually going to say, folks, in some markets, like it might be time to buy. Like, if you're buying from a builder in Cape Coral, you're getting like an awesome deal. It sounds like. Anticipate still that market's going to go down, but if you're getting a 3.99% mortgage rate, and you're already getting a 50,000 discount to market, it's hard to go wrong. The big thing with the buy down, though, to remember, everyone, if you do a buy down, is that when you go to resell the home, it's difficult to resell the buy down. Now, you can resell a buy down with an FHA mortgage. The buyer can assume the mortgage, but if it's a Fannie Mae loan, conventional loan, buyer won't be able to assume the mortgage. You should also anticipate, Ed, that values are going to keep dropping in Cape Coral. So it depends also on how long you want to live there, how long you want to ride it out. Don is saying, Nick, where will be a good market to purchase luxury goods such as Prevost, Newell Motor Homes? Newell Motor Homes. This is an interesting question. What market to purchase luxury motor homes? I would say that the market doesn't really matter so much because you're buying, you buy a motor home, you're buying a piece of equipment. You're basically, you're buying a home, but it's more similar to a car in terms of kind of how it works. There's the big depreciation. The value, the replacement cost of your motor home is going to determine more about the value, and then, obviously you're going to park that motor home somewhere. And so you got to understand what the lot rent is going to be if you buy the motor home. One potential issue, and I don't know, Don, if you're doing this like for like your motor home is to just drive around, or you're actually going to live in it. But one issue with buying a motor home or a mobile home or manufactured home and living in it is that you don't get appreciation on land, right? So when home values go up in short periods of time, often it's the land value going up. And then when they go down in short periods of time, often it's the land value going down. So there's the cost of the home to build, the replacement cost, which is what your insurable value is based off of. And then you have the value of the land. So you guys should kind of like think about this. If you're buying a house, you're not just buying like one whole thing. You're buying the value of the structure, and then you're buying the value of the land. And what tends to appreciate most in the long run, especially if you buy in a good area, is the value of the land. The value of the land tends to go up most in the long run. And so, I personally favor buying land, like owning land, like actually owning land around your house, right? Because that is what goes up in the long run most. There is some baseline inflation for the value of your structure. The value of your structure will go up with the rate of the cost of labor and the cost to build. But I think it's really interesting to think about your investment if you're buying a house, to think about it in terms of what is the land underneath my house worth, and will this land go up in value or down in value over the long run? And we actually have a metric for you guys on that I want to talk to you about on Reventure app. We just added a data point called the long-term growth score. We have this long-term growth score, which is projecting the areas that are best to buy in the long run based on these key underlying statistics. And this long-term growth score goes from 0 to 100. And you can see in a market like Dallas, we actually have it's a very high long-term growth score. And the reason we have a good long-term growth score for Dallas, which you can think of as like a 10-year, kind of a 10-year estimate, is because the underlying long-term appreciation, wealth, demographic growth, affordability, and valuation are good. So Dallas, you can see, crushes it in long-term appreciation, wealth, and income and demographic growth. It's not so good in affordability and valuation, but it's getting better in affordability and valuation because it used to be like a 10 or 15 out of 100. Now it's a 40 out of 100. So we like a market like Dallas. We actually like a lot of markets in Florida for long term because the valuation on some of these markets is improving. And I was almost surprised actually how good some of these long-term growth scores were in Florida. Again, this is like a 10-year outlook going on for some of these Florida markets. Orlando's an interesting one. Why does our long-term growth score in Reventure app like Orlando? Well, existing appreciation is great, wealth is okay, demographic growth is huge, affordability is not so good, but valuation is middle of the pack. So that suggests Orlando is a better market to buy than some other markets. Now, where do we not have such a good long-term growth score? You could see, interestingly, like a market like Knoxville, we don't have a good long-term growth score. You could see markets like a lot of markets in California, we don't have a good long-term growth score. You can see it's actually a lot of areas in the Midwest. Our long-term growth scores aren't so good. So make sure to check out that long-term growth score on Reventure app. You can access that under a premium plan. And that's going to help you look beyond just a year or two, look 10 years into the future. Because, in the end, if you're buying a house and buying investment property, a lot of you are buying for a long-term hold, long-term horizon. You're going to want to understand how those metrics look in your market. So go to www.reventure.app right now, everyone. This is a great tool for you to use. This is a tool I actually invented. I created Reventure app for all of you out there to help you analyze the housing market. Go on Reventure app right now, hit map, start looking at the different areas for you to buy a house. Let's see here. Start looking at the different areas for you guys to buy a house. Start looking at states, metros, counties, and get down to that zip code level. You can access our long-term growth score under a premium plan, as well as our price forecast, $49 a month. Ultimately, that's a very affordable price to the cost of buying a house. The annual pass is even cheaper. You could save 32% on the annual pass. So head to www.reventure.app right now.